Thanks for tuning into Harvesting Income, and special thanks to all the people who watched the previous video on HHIC and Canny ETF, which was very popular, and you know um, people wanted more of those type of videos, and that's one of the reason for today's video. We are going to discuss two major funds: HHIS, the Harvest Diversified High Income Shares ETF, and BIGY, BIGY, which is from Evolve US UltraYield ETF. You see that on the screen. So we're going to discuss these two today and understand how these funds work and comparison of them, the investing strategy of these funds and how they work, and a little bit of the pros and cons. Uh, and I'm also going to talk about uh, some overview about this kind of segment, which is really hot. These are funds which have a basket of stocks, YouTube stocks, and they write covered calls. So you get a diversified basket already, just like an index. But this is not an index. This is a basket of stocks chosen by the company based on their own research and based on their own analysis of markets, analysis of different companies and opportunities within that space. So it would be a great addition to one's portfolio because it's fairly diversified and you also have the potential for higher income from covered call writing. So if you are someone who is more growth focused, you can look at other funds. But if you are someone who needs that regular flow of income, you can look at these funds. But before I jump into comparing HHIS and BIGY, I want to give you an overview, which I did in the previous video. And if you had missed it or for people who have not seen it, I'm going to quickly go through that. This would be relevant more for Canadian investors who look into invest in the US markets. You basically want to get an exposure to the US markets and you want one package solution. These funds are good options. Let me quickly give you an overview about the whole category, not just this fund. So you will understand what types of products or what type of you know solutions funds are bringing, and so that you'll know when new funds come up, you know what's coming up. So these are the high yield platform ETFs. I have put the you know common word for that, which is the high yield platform funds. And in this, there are different types of funds. Like I was talking just about one type of fund, which is like a diversified basket funds. But there are different types. Like for example, you have single stock funds like MSDE, which invest in one stock. So that's one type of fund that these ETFs are coming up with. And the reason they call it as a platform is because once they launch a couple of funds and the format is working, they will launch more funds. Like instead of MSTE, they might come up with another fund for Coinbase, another fund for a different company, Robinhood, and so on. So it is like a kind of a model or a format they follow, and then they're going to launch more funds for different tickers, or they may launch it for different baskets in the future. So one option that funds uses to give single stock funds like Apple, Microsoft, etc. Like they invest in the single stock and they write calls on the single stock to generate that income. That is a very simple one. There are some funds which are sectoral or theme based, the second category. So these would be the funds that are more focused on the industry or sector that they are focusing on. Sometimes it could be a smaller index, like for example Nasdaq, or a particular index too sometimes. So it depends on how they choose the sector. For instance, you have the tech funds like TQQY, or some funds invest only in banks, some funds invest in only industrials, some funds invest in only utilities, some funds invest in consumer staple companies, or consumer discretionary sector, and so on. So those are the other options. In this one, you still have a better diversification, because rather than investing in single stock ETFs, with the covered call, you are investing in a sector and you're getting a basket of stocks. So you're not dependent on that one company or one stock. If something happens to one stock, the above single stock ETFs can get hammered. Like, So you understand what I'm saying? If your stock drops by 20% tomorrow, the single stock ETF is going to have a huge drop. And the other problem is when the stock goes up 20%, it's not going to go up at that level because it's a covered call fund. And when they write covered calls, the upside is going to be limited. So that way, now you understand the pros and cons of single stock ETFs. Sectoral ETFs are somewhat better, but again, if there is a one event or one big trend in the market affecting one sector, let's say there is a trend in the market affecting the technology sector or something related to the AI news or something that's impacting that sector. So then you will have an impact due to that on your portfolio. Like, so if the entire tech sector is selling off, like everybody is selling off, then your sectoral fund is also going to take a hit. Similarly, if you are investing in real estate sector fund, and if the real estate sector is going through a tough period and all the companies are not able to report higher profit margins or great results, then you will see the sector moving down or the sectoral price moving down, and those funds are going to get affected. So that's about the sector funds. Now, the third one is like a diversified basket. And some of the recent funds that we have seen, like including the Harvest High Income Canada and Harvest High Income US, you see a trend towards a mix of different stocks across different sectors. You know, earlier it used to be just the tech sectors that were popular in this category. Now you have not only tech sector, but also you have oil and gas or energy. Plus, you also have the big banks, and you have large utility companies. Apart from that, you have huge consumer staple companies, consumer discretionary companies, travel companies, and so on. That makes it a diversified basket. So this is far superior to the above two categories. So overall, just to give you a quick conclusion on this, you have these three different types of funds: single stock funds, sectoral funds, and diversified basket funds. So if you're a more conservative investor, like I would tell you to stay away from single stock and sector funds and just focus on the diversified ones. If you are highly conservative, okay, this is not financial advice. I'm just giving you the broad idea. But for someone who is more moderate or willing to take a bit of risk, sectoral funds are a good space to you know um, look at if you are someone who is looking at investing in a particular sector because you see and you have done your research and you have found that this sector has excellent future prospects and you want to invest in that sector and you have a strong conviction backed by facts and research, then go for the sectoral funds. And single stock funds are also suitable, but only for a small fraction of the investors because if you have to do this single stock funds for a moderate or a conservative investor, then you will have to use a multiple funds, and that can get expensive. Or if you want to choose only a bunch of single stock funds, like five funds, or meaning five stocks, your exposure is just limited to those five stocks. That's one risk. The other thing is, even though you're investing or betting on that stock, you're not getting the full appreciation. You're going to get capped on the appreciation side. Your growth or appreciation is going to get capped. And on the other side, if the market tanks, the fund is going to lose value. The fall is going to be in more or less in proportion to the market, maybe slightly less, but your upside is capped. And the other problem is if the company that you are investing in is not good, that's another risk. As of now, we only have the blue chip companies in this category in the single stocks and also in the other sector, other categories. So far, these funds have been doing well, and yeah. So these are the different types of products available. So if you are trying to pick a product, you have to look into the details of that website or the fund, the prospectus, and other information. Yes, if you liked what you're watching, please, feel free to subscribe to our channel and share it with your family or friends. And we'll go right into the first fund, HHIS. Okay. The name of this fund is How is Diversified High Income Shares ETF? Okay, so that's the name. And on the right side, you have the ticker HHIS. I think probably it's not visible on your screen. Yeah, so just making the fonts bigger so you can see it on the right side. HHIS is the ticker. The distribution is about 27 cents per month. Decent amount of distribution considering the NAV is only 12.95. Price is around 12.95. And the assets under management is 1180 million, like 1.1 billion. uh, Fairly big size of the fund, and the fund is Canadian currency hedged. Management fee shows 0%, but you have underlying funds. They invest in other funds within the same harvest, you know, portfolio. Within the same harvest, they have other funds, other products. This fund invests in those products which are spread across different stocks. I'll explain to you as we move ahead. So management fee technically is 0.4% for the underlying funds. So let me look at the notes here, the keynotes that they mention, advantages of the fund. Diversified exposure to the top trading companies, higher monthly income, tax efficient. So with respect to tax and other information, you need to consult with your tax advisor or accountant. But all the other advantages are pretty, understandable. Like basically, it's a diversified exposure, higher monthly income, and modest leverage. The fund has a 25% leverage. So, yeah. So basically, this fund seeks to provide high monthly income and growth potential from a portfolio of single stock ETFs, and they have approximately 25% leverage, which helps you to get that high monthly distributions. Okay, so that's how the fund works. Basically, hold a basket of single stock ETFs. So this fund is not holding single stocks, but it is holding a basket of single stock ETFs. So automatically that diversifies the portfolio. And secondly, they use covered call strategy and they use 25% leverage. Okay, there's one small thing which I'm missing. I'm trying to see what is the covered call coverage, basically how much of the portfolio is returned in the form of covered calls. So let's go down and find out if you can get that information. So they have all these companies within the fund, about 19 companies. This list can change over time. So right now they have all these big names. You see the Broadcom, Nvidia, Alphabet, Tesla, AMD, Palantir, Microsoft, Apple, and so on. You have a mix of all types of companies, not just the ID names, but also all these cryptocurrency names, the Costco, Coinbase, Netflix, and so on. So it's a nice diversified basket and all blue chips. I think no name is very small or mid-sized. These are all very large, giant companies having a great influence on the market. And we have the distributions here. Distributions have been like they started at $1. Okay, I don't see the previous. Yeah, okay. From July onwards, if you see, like they started around $1.50 in July, and it's gone up $1.75, $2, 2.26, 2.53, and so on. If I go further behind, like June, May, and so on, like it's been pretty less in the initial stages. Like in February and March, it has been like a lower amount of dividend they distributed initially, and after seeing good performance, they have increased the dividends distributions. That's a great news. Okay, so that. These are the funds they have in the portfolio, like Harvest Alphabet, Enhanced High Income Shares, Broadcom, HIS, Eli Lilly, Apple, Tesla, Nvidia, and so on. So these are the funds they have in the portfolio. And yeah, so there you have it. That's the portfolio. And one thing which I have to again quickly check here is what is the um, okay, let me check my notes here. Yeah, so basically what the fund does is they can invest up to 50% of they can, write covered calls up to 50% of the portfolio. So that's the uh, mandate they have. So they can write up to 50% of the portfolio uh, in terms of the covered call. So basically 50% of the portfolio and 25% leverage. I'll come back to this comparison later, but first let me show you the BIGY ETF, and I'll walk you through all the features, and then we'll do a side by side comparison. As you know, BIGY is from Evolve, or you can say Big Y, whichever way you want to call it. Uh, this is Evolve US Equity Ultra Yield ETF. This is again a kind of a branding that they have branded these ETFs, Biggie and Canny, under the Ultra Yield, umbrella brand. And you also have another new fund, I think, 6E, SIXY, where they have put in all the six large Canadian banks into one ETF, and that is also Ultra Yield because it's a high yielding fund. Okay, so yeah, so basically this fund is meant to provide you high monthly income from leading US companies. So equity income with modest leverage and distributions paid twice a month. So the unique twist with or Ultra Yield ETFs is that they pay distributions twice a month. So that way, not only that you're getting a high yield, but you're also getting it at a higher frequency, like twice a month, just like you get a paycheck or salaries and all that. So you get something like a bi-weekly, payment. Let me quickly go through this quick summary. The ticker symbol is BIGY. I think the font size is pretty small, so I'm just making it larger. Yeah, BIGY. The price level is around $24. Distribution is around 31 cents, and they have 10 stocks. So this portfolio is more, I would say, concentrated or focused. And here you can see the style actively managed with covered call strategy and 33% leverage. So this fund has a little higher leverage. The Harvest fund had a 25% leverage, but this one has a 33% leverage. So in terms of leverage, this is more risky. And also the fact that the portfolio is more concentrated. So this should be more suitable for moderate or slightly aggressive investors. For conservative investors, Harvest seems to be a good one. But let's not come to any conclusion now. We're just looking at the basic information now. And distribution is made twice a month. So, but on the face of it, this looks like a bit more volatile, more risky. Okay, Biggie invests in leading U.S. companies and employs a covered call strategy. That's the basic description of the fund. And the covered call strategy and approximately 50% of the portfolio with modest leverage, like 33%, to generate enhanced income. This one ticket solution delivers cash distributions twice a month for more frequent investor cash flow. Yeah, so that's the target that Valve is trying to pitch to. Like they are trying to pitch a one-ticket solution for people who are looking for this quicker or somewhat of high frequency cash flow, and also the other parameters are more or less similar. Moderate leverage, approximately 50% they write the covered calls. There are a few nuances and new differences between this one and the Harvest Fund. I'll come to that. But the design seems to be more or less similar, but Evolve seems to be slightly more on the leverage side, and they're highly focused or concentrated on the portfolio design front. So those are the differences I can see now. So I think that's about the fund, and the main thing, the management fee is again 40 basis points, 0.40%. Um, Distribution is looks pretty attractive. I've not calculated the dividend yield, but this looks pretty attractive. Um, yeah, so that's about the Big Y fund. Let me do a side by side comparison. I'm not going to compare the yield right now because this fund is pretty new. This was launched in September 2025, so hardly 3 months. Whereas Harvest is pretty slightly older. Like they have a history. Basically, they were started January 2025, January 16th. So come January 2026, Harvest high income shares is going to complete 1 year, and that's the perfect time to do the 1 year review and 1 year video on this. So I'm just hoping that probably in end of January or February I would be able to do a full review on this fund. But for now, let's do a quick comparison to see where things stand. Now I'm going to do a quick comparison of HHIS and Big Y. Yeah, the difference in the two different funds, and HHIS launched January 2025. This one is September 2025. So Big Y is fairly new to the space, and in terms of management fee, it's more or less the same. It's just a design that HHIS has, underlying funds, whereas Big Y is directly investing in those stocks. Portfolio selection of blue chip stocks, basically blue chip ETFs, and in this case, you have blue chip stocks. Let me increase the screen size. I think you're not able to see this. Okay, I hope that is clear now. Okay, I'm sorry. So let me go back a little bit. So in terms of management fee, both funds are more or less on the same page. Just the way the management fee is structured is a little different. In terms of portfolio, Harvest HHIS has a selection of blue chip ETFs, but they have around 19 different stocks. But in Biggie, they have only a selection of 10 stocks. So Biggie is more like a smaller in terms of number of stocks. But the concepts are more or less similar. Blue chip stocks and diversified, similar kind of, approach. An investing strategy for Harvest is basically hold the blue chip stock ETFs and write covered calls for income and use leverage to enhance income. And in Big Y's case, it's the same kind of strategy, not much different, not much of difference. And the difference comes in the covered call right level. This is the nuance that I was talking about in the video. This is one of the reasons why you need to watch Harvesting Income channel, because knowing these features, nuances helps you to not only make your income but also grow your income, because you can invest in any fund blindly and make income, but if you want to grow your income, you need the right kind of approach, right kind of guidance, and the right kind of knowledge and insight and wisdom. And so, if you want to see more of these videos, more of this information, subscribe to the channel, and also please feel free to share your comments and feedback too. Okay, back to the topic of the covered call right level. Up to 50% of the portfolio is what is written in Harvest's case, whereas in the case of Big Y, it will be around 50%. So there is a kind of a dynamic, flexibility here. In case of Harvest, the fund manager has the flexibility to write anywhere from 0 to 50%. It can be more or less. The maximum is 50%. In case of Big Y, the fund actually gives some flexibility to the fund manager, so they can use the discretion, and it can be around 50% of the portfolio, around 50%. Like, not, they don't want to make it too less, too high. It will be around 50% of the portfolio. But I'll tell you one more fact around that once we complete this table. In terms of leverage, um, Harvest ETF, like, they use 25% leverage, which means that your returns are going to be impacted by 1.25 times. So if let's say your underlying stocks go up by 10% overall, because of the leverage, um, the fund will tend to go up around 12 and a half times, 12.5%. Sorry. So, but that's on the positive side. But if the underlying stocks go down by 10%, the portfolio is also going to get impacted by that much, like 12.5%. That's just to give you an idea of the leverage, keeping other things constant. There are other factors, other moving parts. So it's not just a strict mathematical thing. There are other factors too. And similarly, on the other side, like, Evolve has a higher leverage. So that can be a double-edged sword. So when the returns are positive, you're going to get 33% more returns than the underlying. But when the underlying returns are negative, you're going to get, you know, less than that. So that can be a little, tricky, like, when leverage is used. So if you are conservative, like then Evolve's BIGY may not be a great pick, or you have to make it a small portion of the portfolio so that you can tolerate that kind of volatility or kind of uncertainty, or you can say kind of uncertainty in the final performance of the fund in terms of returns. Okay, so and the distribution frequency varies. Harvest distributes monthly, whereas BIGY distributes twice a month. Okay, whatever I am saying here is just based on my observations and the data provided on the website at this point of time. So at any time you want to check the funds and you find something attractive based on this, do your own research and also double check some of the key facts so that you can make a right decision, and also consult with your financial advisor or accountant if you need anything, any advice or any suggestion on the tax front or on the investment front. Okay, so with that, let's go quickly back to the video and back to the main page. I wanted to emphasize another thing, but I'm not sure this video will be uh, able to do the justice. But Evolve has actually another small, uh, feature here, which I wanted to highlight, which I read in the prospectus. Um, this could actually make it more dynamic in the future. So in the Evolve prospectus, they clearly state that the covered call options will be written by the manager at its discretion on up to 100% of the equity securities of the portfolio at any given time. So this is another small point that I want to emphasize, that the prospectus which is much bigger than the fund snapshot that they give. The fund snapshot says that it's going to be roughly around 50%. The covered call writing would be about 50% of the portfolio. But there are situations where the fund manager may be given the mandate or the instruction to decide to do more than that or even up to 100%. It all depends on the situation. So just wanted to highlight this point, not go too much detail into that, but this is only in case of special cases they might be given that kind of mandate. Okay, so all in all I would say both funds are equally good. But what I would say is, like, if you are looking at something with a good track record right now among this category, HHIS seems to be a good pick. And again, this is not financial advice. The reason I am tilted towards HHIS is because it has 11 months track record and they have been increasing distributions. And the performance of the fund has been good. And there's not been much of a NAV erosion, or I don't see that as a big problem. So far, HHIS has been good. I can also check the price in front of you. So if you look at the HHIS stock price, um, it's been about 11 months, not even a year now. So if it started at around $12, and this is in around January 2025, early part of January this year, and then you saw that big drop here. You can see that big drop in April 2025, like around April or May. This has been, around April it was down, and in May it recovered a little bit, and once it recovered around $12 or something, then it's been on an upward swing a little bit. But these funds move a little slowly. Like this is an exception where you had this big drop in April, May, around that period. That's why you see these big swings. But usually they go up or down pretty slowly. But once you saw the fund recovering about $12 in around June or July, then it has been more or less around the $13 mark. Recently, it fell to close to 12.45 in November, but then it recovered back to the $13. So, this is one good fund to look into, HHIS, and Wiki is not far behind. And even you can look at CANY, CANY, which is the Canadian equivalent in the same space. So you have a lot of funds to choose from. So there is no rush, or there's no need to get into that FOMO fear, because you will have more new funds coming up, and the older funds will still have some track record. And among the funds with a good track record, you can choose the ones which suit your investing style, or the funds which have performed really well. So you have a great choice or great variety of funds to choose from, especially in the Canadian market because these have been launched recently. But I hope that in next year, another dozen funds are going to come in the same space, and you will have a lot of options to pick up from. Not only that, there are new funds and variety, but you will also have the management fee, which is getting slashed. So, if you watched my previous video on ECHI, they have actually slashed the fee and competing on the fee front. So it's going to get cheaper as well. So wait and watch the space, and I hope you will find a good selection in the coming days. And also, you will have a selection from the previous funds as well. I hope you like this video. And if you like what you're watching, please subscribe to the channel and also drop in your feedback or comments. And like to hear from you. Thanks and have a great day.